My name is John Jiminod. I'm the Regional Vice President of Sales here at Angel Oak Mortgage Solutions. This webinar is a deep dive into products. We've had, including today, we had another enhancement. We've had 35 enhancements since June of 2020. So this isn't going to be about the 25 securitizations we've had. It's not going to be about the 11 securitizations we've had since COVID. It's not going to be about the 3.3 billion we've originated in 2019, and it's not. I'm just going to mention it right here about our record month last month, and this is our strongest time of the year. So it's important for you guys to really learn non-QM and all the programs. So today I have the pleasure of absolutely working with two of the best in the business. I've got Alina Derget, who's coming off a record month. Alina, introduce yourself. I introduced you, but tell us a little bit about yourself.
Hi, guys. I'm Alina. I've been with Angel Oak for a little bit over 3 years now, and I take care of South Florida market here in Fort Lauderdale, Broward. I'm looking forward to doing this webinar with everybody, answering any questions, and hopefully for those that are not signed up, we'll get you guys on board so you can start growing your business. Looking forward to it.
Thank you, Alina. And then Leslie Rudd, a veteran in the mortgage industry. Leslie.
Hi, folks. Leslie Rudd. Industry, 20 plus years, been with Angel Oak 5.5 years, so almost since its inception. Really incredible the growth that we've, and the whole space and non-QM space that has taken since then. Really look forward to assisting everyone, giving some more information on what non-QM can do to really grow your business. Look forward to it. Thanks, guys.
Thank you, Leslie. And again, I'm honored to have the pleasure of working with them day in, day out. So this is going to be fun. So before we get into this, I just want to let everyone on the call know, please submit your questions. This webinar is for you, and all of you have taken your time out of your busy days to learn about non-QM. This is going to be recorded, and if by chance we don't get to all your questions, we will have your account executive reach out to you personally no later than end of day tomorrow, and the recording will go out to you no later than end of day tomorrow. So without any further ado, let's jump into our programs. But before we jump into our most popular program here, which is bank statements, we're going to do a quick poll. So if you could participate here for the next 10 seconds, we look forward to hearing your feedback. The poll question is, who has originated a bank statement loan in the last 12 months? So give it a couple more seconds here. Guys, this is our 12th product webinar. We've been doing this for over a year, and it's amazing how the statistics don't really change. We've had 77% of the people that responded to this poll have not originated a bank statement loan in the last 12 months. So just to put these in perspective for everyone, there are more self-employed borrowers than there are VA borrowers. So this is a huge market share. So Alina, take us away. Give us some highlights of our bank statement program, please.
Thank you, John. So bank statement program is probably one of our most popular programs. It is perfect for your self-employed borrowers. One of the recent changes that we've made to the program is we reduced the credit score requirement down to 600. We will go up to 90% LTV, and there's no MI guide, which is a great saving for your customers. Minimum loan amount here is 150, which is a hard stop, and we will go up to 3 million. You have an option to do either 12 or 24 months business or personal, depending on your borrower's specific scenario, just not both. Housing event for bank statement program is 2 years. Foreclosure, short sale, BK, deed in lieu. We price it out as a 30-year fixed program on a pricing engine, but you do have an option of going interest only. One of the major requirements here, guys, is that you do require 2 years of self-employment. Some people get confused because we're offering a 12-month bank statement program that it can be a 1 year self-employment. It has to be 2. You have an option to do purchase, cash out, and rate and term. And the way we calculate income, if you go on business bank statement route, your borrower has to be minimum of 50% owner of that business. On a personal, it's 25%, or if your borrower is not incorporated, just have to be self-employed minimum of 2 years. We do all the work for you, which is very, very important. You do not have to go through the statements. You do not have to figure out what the income is. All you do is send us a completed 1003. You can leave the income off, credit report, 12 or 24 months of bank statements, and we will work those numbers for you and send you the worksheet back so you know what your borrower qualifies for. Very, very important. But do please make sure that the 1003 is completed so we can work out our ratios on our end so you know exactly what your borrower qualifies for or not. When we calculate income, we automatically apply 50% expense ratio to the business. That being said, if applicable, you can go down to 30 and 15%, and in the same token, you can go down up to 70 and 90, depending on the type of the business. And each case is going to be different, and each scenario is going to be different. This program is probably hands down one of my favorite. It increases your borrower's purchasing power. 9 times out of 10, I get a pre-qual. The loan amount could be $250, $350. When the customer sees the income that they qualify for, they increase their purchase price, which is great for you guys, and it's great for your realtor partner as well. And we do allow non-warrantable condos under this program too.
Yeah, Alina, great highlights. And Martha, thank you. And I love the interaction we get from our audience here. Martha just closed her first bank statement loan with us. So thank you, Martha, for your business. I really appreciate it. So Leslie, one of the first questions we have coming here, does it have to be in the same business for 2 years?
Yes. So sometimes we'll get, and I have to be guarded sometimes to say you must be self-employed X number of years, and they'll come back very excited, and then they'll tell me, oh, but he was self-employed doing something up to a year ago, and he switched industry. No, it has to be the same industry, same business for at least a minimum of 2 years. Yes.
Yeah, thanks, Les. And Alina, another question here, guys. Keep the questions coming, and if we don't get to them, like I said, this is being recorded, and we will get your account executive in touch with you no later than end of day tomorrow. Sorry, guys. I'm reading all the questions coming in. So, Alina, I know you mentioned DTI. Can you just go over? I have another question about DTI. What's the max DTI on this?
Sure, it's 40 over 50, 50 on the back end. Now, if LTV is over 85% on the bank statement, the DTI goes 40 over 45%.
Right. Hey, Les, one of the things we get, Alina talked about how we calculate the income. Give us some details, between the expense factors again, just so, give us some examples. We have some questions well, how do we know what the expense factor is going to be?
Great question. So I'll give you a generalized version. There are always detail specifics. So you definitely want to get with your local account executive just to drill down. When you send us the bank statements, we have a bank statement review team that we send that to. They work up the worksheet to give us the qualifying deposits and then the qualifying income. That worksheet is defaulted to 50% automatically. So you get a 50% haircut. So if gross deposits on a monthly basis are $20,000, we're going to return the worksheet to you and say your qualifying income is $10,000. If that $10,000, that 50% haircut works fine, comfortably, we're done. We don't need anything else. That's your qualifying income. Depending on the type of business and how your borrower runs their business, we could go to a lower expense ratio. So if it's a small mom and pop operation, a one-man show, one-woman show, we can go down to a 30% expense ratio or even as low as 15% expense ratio. So we can give you more qualifying income. However, to be able to use those lower expense ratios, we would need an additional document from a tax preparer or accountant or CPA confirming that borrower's expense ratio for that business. So with that letter, we can go ahead and use more qualifying income if need be. But as I said, if 50% works comfortably, no reason to complicate the matter. We just go with the 50. If not, we dig deeper, we get the expense ratio letter, and we can move forward.
Yeah, guys, there is some work up front on these, but the income calculator, I think Alina mentioned this, the income calculated here is what the underwriter is going to do. We're not going to start going through those bank statements and try to recalculate it. So what you get a prequal from Alina or Leslie, That's the income that's being used. And you feel comfortable enough with that pre-qual letter, that's it. And Alina mentioned this earlier. I don't want to, miss this point. We can increase your borrower's purchasing power 3-4 times. How great is that for your referral source? Alina, Tori has a question about condos, LTVs. Are those the same as single family LTVs?
Yes, they are. Even if it's a non-warrantable condo, it's the same breakdown.
Thank you, Alina. Tori, hopefully that answered your question. And Jeffrey, yes, when Alina talked about DTI, it is 40% on the front, 50 on the back. So hopefully we're answering all these great questions. Alina, talk a little bit about what if you have a borrower who's self-employed and their spouse is W-2'd?
Great question. We will allow that. So when you submit the pre-qual over to me, you will have the self-employed information filled out without income. And for the co-borrower, you will put that W-2 income. We do not pull 4506s on the bank statement program. For the co-borrower that's a W-2 employee, we'll do 2 years of W-2s and a 30-day pay stub. In the same sense, if your customer has both self-employed income and W-2 income, but W-2 income from a completely separate job, not the one that's part of the self-employed business, we'll allow both of those incomes as well. You'll put in the W-2 income, and then we calculate the self-employed income for you.
Yeah, so, and Charles, great question here. How are you going to get paid? We do allow borrower paid and lender paid comp on this. In fact, that was another enhancements on our bank statements today. We increased the lender paid comp to up to 2.5 on that. We're going to show you a very, very cool pricing engine after we get through our deep product dive here. So keep the questions coming. Yes, so Rosemary asked, Leslie, can we do a pre-qual on a TBD?
Absolutely, be happy to. No issues whatsoever. We do them all the time. That's fantastic for you because then you can know, especially on the bank statement program, you'll know upfront. We've given you the qualifying income, so now they know what their purchasing power is and what they go shopping for. So absolutely, be happy to always do a TBD pre-qual.
Yeah, so Alina, give us some examples of how our team of experts are going to look at deposits. Maybe do a couple quick examples for personal and then, what we do for business.
Sure. So when we look at income, we look at qualifying deposits. Obviously, purchase returns, interest earned is not going to be a qualifying deposit. We do look at irregular deposits as well, unless you show me. So for instance, it is typical to the business where every 6 months they get a large deposit. This is why I always recommend get 24 months versus 12, so you can show me that history that is typical to the business. So the bank statement review team is not retracting that large deposit because that's a common thread. On the personal bank statements, if it's transfers from another checking account, savings account, and so forth, that is not income and it will be taken out. Only in a case where borrower has a business account, and let's say we're doing 24 months income calculation on personal, and you can provide me 2 months of business account, and borrower is minimum of 25% owner of that business, we will allow transfers from that account into personal, and we will give you 100% of income versus hitting with that expense ratio because we're assuming expenses are coming from the business account. In the business income calculation, it's a lot more easier to get most of the deposits included because business have deposits all over the place. But again, transfers, if you've seen transfers back and forth from multiple accounts, then those deposits will be taken out.
Yeah, so David, David's question is here, how do we know if we should send personal? Send them both to us. We have a team that's going to calculate that. But it really, you and your account executive are probably going to preview a couple of the bank statements and say, you know what, don't bother, let's go with the business. I think 60% of our business is done in business, is done with the business bank statements versus personal bank statements. But again, it's great that you have options here. And really, it's really up to you. And I love that, we have almost 200 people on this call today that you're taking the time out. Just get all the information up front. Tell your borrower to send you the business and personal. We'll take a look at it because we will determine whether you should go 24 or 12. So Leslie, give us some examples on why you might go 12 months instead of 24?
You're right. So a couple different reasons, and they're all valid, and that's why we do the work up front. There's an old saying I remember from a previous job. Yeah, you fight hard to work easy. So we fight hard up front. We do all the legwork up front. Once we've got it all out of the way, you know that when you're underwriting, that income is golden. You don't have to worry about chasing other income docs. Oh, I forgot to pay stuff with W-2, none of that stuff. Income is done for you. Why 12, 24? Sometimes. Could be an issue of declining income. So if you give me 24 months, the previous 24 months, you had a lot more cash flow. The last 12 months, and we have basically, it's a 30% tolerance. So if the decrease from the previous 12 to the current 12 is over 30, it's going to be a caution. But yet, the most recent 12 still work comfortably. The income still works. It's just we've shown that decline. We have no problem. It's not an issue whatsoever. So just remove the previous 12 and go forward with the current 12. Another reason may be overdraft NSF activities. Again, we typically do not like to see more than 6 overdraft NSFs in any 12-month period. I just had one just yesterday where I had to drop the previous 12 because in the previous 12, he had 9 overdrafts. And so obviously that was a decline on the 24-month. But the most recent 12, he only had 2. So no problem. We get rid of the previous 12 and use the most recent 12, and we're qualified there. So that's just a couple of reasons why we would go 12 over 24.
Yeah, so great, Leslie. Thank you. Couple of clarifications here. So when Alina was explaining the personal bank statements, she did not say we will use 25% of the deposits. The borrower, if we're going to use personal bank statements, the borrower only needs to be 25% or greater ownership in the company. So, and if they provided 2 months of business bank statements, we would be able to use 100% of the deposits. So hopefully that clarifies. I think that was Arlene's question. So hopefully, Arlene, we clarified that question for you. A couple of questions, Alina, here were, what are the scores for 85%, and what will we go down to? What's the lowest score we'll go down to on bank statements, Alina?
600 will give you 70%, 640 will give you 80, and then 660 will give you 85. To get to 90, you need a 700 plus credit score.
But guys,
600 will max out at 70.
Yep, thanks, Alina. So, but you really need to stay in touch with your account executive because, as I mentioned, just in the last 2 weeks, we've had 2 really large enhancements on our program. So, and we just lowered rates across a ton of buckets this morning. So you really, really need to stay in touch with your account executive on all the latest and greatest enhancements. A couple other questions. So we answered that already. Property types, Leslie, what type of property types will we allow on our bank statement program?
We will allow single family, condo, and duplex. Do we go fourplex? You got me on that one, man.
We'll go up to 4.
Was that a test? I'm sorry?
We go up to 70 on fourplex.
Up to 70 on fourplex. Now, again, new enhancements. And I apologize, because I literally had to print the new matrix because just today we got another enhancement. So like John was alluding, we have had enhancements after enhancements, and sometimes it's hard for even me or us to keep up track of what we will or won't do. And all to the positive, because they're opening the buckets and the spaces more and more and more every day. So bottom line, everything up to a 4 unit, anything above 5 unit, we are not involved in. So 5 unit plus, we don't do. But anything other than that, we do, including condos, as Alina alluded to earlier, up to 90% on condos.
I wanted to add something. John, can I add something? For one of the enhancements from a couple of months ago, that we will allow a duplex to be treated as an owner-occupied property with a quarter hit to the rate, which is a great plus. Great.
And then I've had a couple other questions here. We do this for all purchase, all refinances, and all cash out. So, we've seen a great appreciation in home equity across the country. And why not get that self-employed borrower, do some cash out, tap that equity in their in their house and maybe reinvest it in their business as they continue to grow. So think about those. The thing I love about cash outs, you're taking a contract date out of the equation, you're taking a seller, a seller's agent, and a buyer's agent out of the equation. That's really advantageous to growing your business. Almost create your own non-QM refinance out there. Yes, great question here. Alina, talk a little bit about the 1099.
1099 is basically a mirror of a bank statement program. It was created to help you capture that fallout business that was due to inconsistent deposits, which in turn made the worksheet come back as declined. For instance, you have somebody that's like a realtor that might have 1 month of a big deposit and 2 very little or none and so forth. So the worksheet was always coming back as declined due to inconsistent deposits. So we created a program called 1099 only with the year to date, which could be in the form of a pay stub or bank statement. And you have an option, just like a bank statement program, to do 1 or 2 years. And again, when we calculate the income, we have a worksheet where we can plug these numbers in for you. We also apply an expense ratio to this as well. But typically for a 1099 employee, it would be at 15%. One thing I want to say that's very important, 1099 has to be in the borrower's name, not a company. And the borrower has to be employed with the same business minimum of 2 years.
Yeah, thanks, Alina. And a lot of questions about this being recorded. Yes, it's being recorded. We will get this out no later than end of day tomorrow. And there's a ton of questions, so we really do appreciate. I love the thirst for knowledge on our programs. If we don't answer your question here, we will get your account executive no later than tomorrow by noon. Get your questions answered. It's almost 25 after the hour. We've got a bunch of other programs because we've launched a new program in the last 2 weeks, so we really want to get to that. But before we talk about our second most popular program here, we're going to do another poll. Our investor cash flow, or as a lot of people refer to this as a debt service coverage. Let's launch another poll. Who has closed within the last 12 months a investor cash flow, or what people refer to as a debt service coverage loan in the last 12 months? Give it a little bit. A couple other things I want to refer to while you're answering that poll question. Just think of this. In 2020, new business applications grew by 24% over 2019. That's the largest increase in business applications in over 10 years. So that self-employed pie is going to continue to grow. So it's really to your benefit to really learn that bank statement program. And we're going to dump into this. So the poll results are in, and I've got to put on my glasses here.
85%.
85, thank you, Leslie. 85% have not originated a debt service coverage program in the last 12 months. Huge opportunity. Government's overlays had made this program become more popular. Obviously, this last night, they relieved some of that, but I think it's just going to be suspended briefly. It's probably going to get put back on in the first of the year. So Leslie, give us some highlights on investor cash flow, please.
Okay, yeah, so when I saw that poll, I was surprised too. So fantastic opportunity here. 85% of you have not done this. You got to get in on this program. Investor cash flow, I'll hit quickly the bullet points and elaborate a little bit. So loan amounts up to 1.5 million, minimum loan amount of 75. And it's all about this. Qualification based on property cash flow, minimum Dscr 1. What does that mean? As we said, Dscr, debt service coverage ratio. That's a commercial loan type of term, but it simply means this, okay? Your cash flow on that property, okay, on the subject property that's either being refinanced or purchased, okay, that cash flow must cover the subject property, PITI, and A if it's an association, such as a PUD or a condo. So if that cash flow covers that PITI on a one-to-one basis, then that is your qualifier. Now, question is, how do you determine the rental income? So when you order your appraisal, if it's a single family, you're going to order the rent comp schedule, which is the 1007 form. If it's a 2 to 4 unit, you're going to use the 1025 form for multifamily 2 to 4. Okay. When that appraisal comes back, obviously 2 things are going to be there: the actual value of the property, but on top of that, there's going to be a separate form, the rent comp schedule. Whatever the appraiser says the rent comp is for that subject property, that's what we use. We give you 100% of that. We don't give you 75% of, we give you 100%. So easy math, easy example. If the PITI on this subject property is $1,000 and the rent comps come in with at least $1,000, you're covered. That's where you qualify. Now, next bullet point. No DSCR needed with minimum 700 score, max 75 LTV. So what could happen from time to time? It happens. The comps come back and it doesn't meet a 1-to-1 ratio. If you drop the LTV, and by the way, I should have said before earlier, we'll go up to 80 LTV on this. So let's say you did request 80, the comps didn't come in. If the deal can still work at 75 and your borrower has at least a 700 score, then that's fine. We can waive that Dscr requirement and we can still save the deal at 75. So that's a little added feature that we have on that one. Next, when we get the application, we do not want to see any personal income. This is a no income qualifying product. We're not running DTI. I don't care what their income is. I don't care what the rest of their debts are. We're not looking at that at all. Again, going back to, this is cash flow only. That's all we care about. We don't really need any employment information. We definitely don't want to see any income information on this. We get this question all the time. Can you close in an LLC? We can close in an LLC across any of our products if it's an investment property. This obviously is an investment property, so the answer is yes, you can close in an LLC. Couple details: we allow no more than 2 people in an LLC, and if there are 2 people on an LLC, both must be applicants and both must credit qualify. We really don't care about how many properties they currently own. I know Fannie, I believe it may be at 10, maybe a little bit more now. Is it 10 still? I don't care if they own 30 properties. It has no bearing on us. We don't care about that. Across all loan scenarios, purchase, cash out, or refinance. On a cash out, we'll limit to a 75 LTV. On a purchase, we're good to 80 LTV. On a 1 unit, if it's a 2 to 4 unit, the purchase is limited to 75, but we still will be able to cash you out at 75 on a 2-unit condos also. 40-year interest only available. I'll touch on this real quickly and just give you a quick overview because this is available across, again, all our loan products. So 40-year interest only, and it's a fixed rate. All our products are fixed rates. So when you get a typical Prequal, it's going to be quoted on a 30-year fixed. Okay. If you want to add the interest only feature, the loan payment, the first 10 years is interest only. So the payment will be based simply on interest only. After 10 years, it reverts to a traditional, fully amortized 30-year payment. So the math on the interest only is very simple. Example, we got a $200,000 loan amount, let's say times 3.5%. Well, let's do it another way. 200,000 times 3%.
It's loan amount times interest rate divided by 12.
Divided by 12, so that's $6,000 yearly. Divided by 12, that's a $500 payment. Yeah. Okay.
Yeah. So, and I'm glad Leslie talked about the interest only because a lot of your investors, and even go back to your bank statement, self-employed people, they're very cash flow oriented. So there's been a real big uptick on interest only, and especially if it's going to convert to a 30-year fixed. You know, it's not like it was during, you know, the early 2000s where you're doing these 228 arms and stuff like that. So a lot of people are definitely interested in cash flow. So questions are still coming in. I love it. So Leslie, one more thing about interest only. How do they qualify those? So let's just
tell them. Got to be fully amortized. Yeah, they still have to qualify off the fully amortized payment of, you know, over 30 years. So we still amortize it over your traditional 30-year payment. But if they qualify, then they do have the option of just going in and getting that lower payment. And as you said, especially these sophisticated investors, it's all about cash flow. they want to minimize their outflow on payment. So, but yeah, 30-year AM, fully amortized to qualify.
Yeah, so Alina, talk about the prepayment penalty on our investor program, on all investment properties, please.
So all of them have a 3-year prepay, and then all across the board, and then you have an option to buy it down with the cost up front or a hit to the rate, and you can buy it down to 2 years, 1 year, or no prepay. So it all depends on the route that your borrower wants to choose. Does he or she want a higher rate, or do they just want to pay for that up front?
Yeah, I'm sorry, Alina, I was trying to read through some questions. Did you mention we just added the 4-year prepay?
Oh, I have not reviewed that matrix yet.
Sorry.
No.
So, and again, it literally, it's fresh off the presses.
Did not know that.
We added traditionally, it's a 3-year prepayment penalty. We added a 4-year prepayment penalty, and that will lower the rate by, I believe it's 1/8 of a point. So just something to think about. Getting a lot of questions here regarding what do rates look like, what are, rates, LTVs. We're going to show you our quick quote engine once we get through these programs. So I appreciate that. We don't lend in all 50 states. We lend in about 45. We're not in Hawaii yet. We're not in Alaska, New York, Massachusetts, and I believe Missouri, and maybe a couple other states. So if you tell us a state you're in, I'll tell you, where we will lend. So hopefully, Romeo, that answers your question. And then Leslie, another question here about seller financing.
So up to, 6% on owner occupied, 2% on investment.
Yeah. And just so everyone knows, Arizona is a state we're licensed to close loan in, and so is Minnesota. So hopefully, Shane, we've answered those questions for you. Alina, so one of the things, we've talked about before, 30%, just so you know, everything is a guideline here, right? 30% of the loans we close don't meet our guidelines. So what does that mean, right? That means because of your subject matter experts here, like Alina and Leslie, they have, well over 3 years history of closing loans with Angel Oak, and they know what our appetite is. And they do not throw stuff up against the wall. They get these exceptions done prior to issuing a prequal. So, but I just want everyone to remember that we will talk about our guidelines here and show you some high levels, but 30% of the loans we close don't meet our guidelines. Alina, one question here was, does the borrower have to have a primary?
That's a great question, and kind of feeds into the exception piece of it. So yes, as a rule of thumb, as a guideline, it cannot be a first-time home buyer. You have to have a mortgage, minimum 12 months mortgage history, and the investment property you're purchasing has to be equal or less of value to your primary home. That being said, if you have a borrower that, let's say, lives in New York City, where it's typical to rent, not own, you could probably get around there and get that exception of qualifying your borrower under investor cash flow program. I've always gotten that done because it was a pretty strong file and everything else made sense. Or you have another borrower that just likes to rent but has other multiple investment properties. That's going to be another way for you to get that exception for this program, because your borrower already has a history of purchasing these investment homes and has a minimum of 12 months mortgage history to support it.
So Leslie, great question here. What about short-term rentals? Do appraisers take into consideration that?
No, and I just had a question this morning. I deal a lot with Southwest Florida, where a lot of properties on the water. They got a lot of the VRBOs, Airbnbs, all those short-term rentals. But when an appraiser goes out and does the rent comps, they have to do it off of monthly rent comps. So keep that in mind. It does have to qualify off of monthly rent comps, not day-to-day rentals or weekly rentals or whatever it may be, short-term.
Yep. And Alina, a question here about the ability, does the borrower have the ability to waive escrows?
Yes, we do allow escrow waiver up to 80% on all of the programs.
Great. Hey, I know we're getting close. We're almost 20 minutes to 40 minutes past, so I know we've promised an hour. We will go longer if we have to, but one of the things, really think about this loan when you're trying to get this done conventionally. Or these seasoned investors are going to come in with tax returns probably a foot and a half high. as Leslie mentioned when he gave you the high level recap, we don't want income. We don't want job information. We don't want tax returns. We don't need lease agreements on other properties. We just qualify the borrower on their credit score and that subject property and how it cash flows. So again, this is being recorded. If we don't answer your questions, we want to talk about a new program we just rolled out about a week ago, and it does fall under our investor cash flow program. So we won't get into all the details we talked here. We're just going to have Alina talk a little bit about the high level of what this program is and what it, maybe we'll touch a little bit on what it used to be.
Okay, thank you, John. So for National, I've probably got more calls in the last 4 months than I've ever had in the last 3+ years for this program, because there's not too many lenders out there doing it. And then finally, out of last week, we rolled it out hand in hand with investor cash flow, so it functions and works the exact same way. Maximum LTV here is 7%. We'll do cash out up to 65. No foreign credit, no U.S. credit, no employment whatsoever. So your application will only have borrower's residence and then assets. Minimum loan amount is $75,000. We will go up to $1.5 million. The Dscr ratio here is 1-to-1, the same one as on ICF. Assets have to be sourced in season 60 days, and very important, 30 days has to be in the U.S. account. We do look for 12 months of reserves as well. And another very important factor, ACH for auto payment is required or loan will be ineligible. We have certain places that we will not lend to, which is an OPEC list, and also Osceola County, which is in Orlando. We will not do any investment properties in that area as well. Your borrower cannot live in the U.S., so the residence has to be outside in a foreign country, and they have to have one of the listed required visas that are there on the screen for you guys. And another major thing is no gift funds allowed.
So guys, this is all this. We used to have this as a separate program. If those of you have closed foreign national loans with Angel Oak prior to COVID, this was a separate program. We used to have income. We used to have all this other stuff. This falls under this debt service coverage. As long as that subject property cash flows, we will do a foreign national loan as long as they have either one of those valid visas, or they can also be from a visa waiver country. So just think of that. A lot of it is, but the rest of it falls under that debt service coverage. But this is exciting. You know, for 16 months, we've been getting calls on foreign nationals. We haven't been able to service those borrowers for you. So thank God we've got this now. So again, reach out to your account executive. If you have questions, we'll get that answered here. Put them in the queue. We'll make sure we get those answered. Leslie, we're going to have you take us to our Platinum program.
Okay. Okay, so Platinum is a little bit different than the two previous products, the bank statement and the investor cash flow for national. So Platinum is a full doc product. So it's either going to be, you know, if they're self-employed, they do have the option of going to a 1 year, although again, they must be self-employed at least 2 years, or if they're just a salaried borrower. Okay. So the question is, well, why would I go to you for a full doc product? Okay. This is a little bit of a fallout model. This is what's referred to a lot as just missed. So if you've got, you know, let's say a traditional conventional borrower comes in and he's had a bankruptcy, better example, foreclosure in the last 5 or 6 years. So you're not quite seasoned out, 7 years that you need for Fannie or Freddie for agency. We're okay with it with a minimum of 4 years out of foreclosure. So that is one area where we're willing to go where conventional may not. So again, it's right there, 4 year seasoning. Again, across all different types of you know, owner occupied second home or investment, we're fine with that. Again, purchase, cash out, refis, we're good with that. As I said, full doc only. Going back up to the top bullet point, we'll go up to 3 million on these with a max 80 LTV. We will go now up to 95% LTV on these. No MI on any LTV over 80%. So again, that's pretty big, even on jumbo. So 95% jumbo, Again, that's pretty strong. Again, only 4 years out of a foreclosure seasoning. We're obviously, jumbo lenders just want pristine gilt edge type of paper. So if you just can't quite meet that standard on a prime jumbo, this is a definite fallout model that can help you capture and save those big dollar deals, right?
Yep.
Again, touched on it earlier. 40-year IO also available on this one. As I mentioned, for your self-employed borrower, we're good with just 1 year tax return. Again, it has to be self-employed too, but just think about it. If you want to go agency, I know Freddie I think they want 5 years in employment. So if you got someone who's just been employed 2 or 3 years and wants to buy, and obviously a startup like that, let's face it, the first couple of years are probably rough. They're probably not showing anything yet. Maybe third year, he's finally showing some good profitability, and he can deliver 1 year worth of nice bank statements. Tax returns that will qualify. So that's, and even more so, if you're in the jumbo world, we're okay with him being self-employed at least 2 years, 1 year tax return. So that's another little niche that you guys might be able to capture. And again, going back to non-warrantables, again, up to 90% LTV, we're fine with that.
Yeah, Leslie, I was on a panel a few months ago, and they were talking about how do you qualify self-employed borrowers, and after they talked about how to do it conventional agency-wise, I was like, my God, bank statements are so much easier than that. Show us your last 2 months of bank statement. I was like, wow, our bank statement team makes it easy when we calculate the income for you. We've had a lot of questions still coming up from Foreign National. We promise we will get your account executive in touch with you on those. One question was, I forgot, it was the visa waiver countries. If you Google search visa waiver countries, that'll be out there for you. I know Canada's one, United Kingdom.
Typically any the European Union, anyone that's part of the European Union is on there, and some of our our best allies. I know Japan's on there, probably South Korea, but yeah, if they go to the website, they'll be able to find out.
So let's talk about, Alina, we're going to have you take us to our other full doc program, Portfolio Select.
Yeah, so this one is similar to Platinum, works the same way. I would say the major difference is obviously you go down to 600 credit score, up to 90% LTV, but you have 24 months seasoning for a housing event. And we will allow you to go up even down to 12 months on foreclosure with a hit to the rate, which is it's perfect program for somebody that's had a recent housing event issue. Non-warrantable condos are okay, 40 over 50 DTI as well. Under this program, gift funds are allowed, and you do have a 40-year interest only available as well.
Yeah, so, think of this as a 2-for-1 program. As Alina mentioned, we'll go down to 2 years. Well, why wait to get that borrower in a home where it's going to be 3, 4, 5 years before they can qualify, and who knows what that home's going to be worth by that time. They might not be able to get that home 3 years from now versus today. So think of it as a 2-for-1. Get them in with this Portfolio Select or that Jumbo Platinum, and then once they get that seasoning from that credit event in their life further and further in their rearview mirror, refinance into an agency loan. So, and we don't even know where rates are going to be 2-3 years down the road. So get them in that house, let them start earning equity in that property. It's really, again, stay in touch with that customer. It becomes a 2-for-1. We have people that have been closing loans with Angel Oak for almost 8 years that have their own little non-QM refi boom going on right now. So you can create your own little refi boom once rates start to go up in the non-QM world. So don't forget that. Paolo, great question. Just we will go up to 4-unit property. That's the max on across all of our properties. So last but not least on our programs, Leslie, I'm going to let you take us through our asset qualifier program.
Sure you want to do that?
Favorite program.
Yeah, just do a quick asset qualifier. That's an inside joke with Leslie on this. So
I got my hand slapped about on a previous presentation that I did on this. I was famous for saying, if your borrower doesn't have at least $2 million, don't even come talk to me. It's not that exaggerated, but as implied, an asset qualifier. This is a very niche program that you may not run into that often, but I've closed a few of these, so they are out there. this is definitely for your high net worth borrower, and those folks are out there. So it may be someone who just isn't, again, not declaring any income on their tax returns. But the guy said, but look, I got $5 million in assets. I got $2 million in assets sitting over here, you know, in either cash or different investment accounts, retirement accounts, and so forth. We have a formula, we have a program where we will break down those assets. And it's a little bit more involved here, so I'm not going to go into the weeds on that, on how we calculate it. But there is a formula that we use after all has been accounted for and allotted for. The borrower still must have $500,000 left over. So that's why I kind of joke, you know, it's got to be a little bit higher asset, maybe not 2, but 1.5. If it's 1 million, we're really stretching it. Because think about it, someone who has that much money in assets, they're not looking to buy a $250,000 3-2 ranch style home. That guy's going to buy, or that lady, that gal is going to buy a nice home. So therefore, you really kind of need upwards of a good million plus. But you know, I'm not going to go through every bullet point, but if you do see that borrower, give your account executive a call and ask them to give you more details on this program. We will go up to 75 LTV. Assets we'll do a rear view mirror from 6 months back to currently. So we're going to say, hey, give me 6 months of all his assets. Then from there, there's a formula that we calculator that we use, and we'll come back to you that same day. We can tell you, hey, listen, yeah, we're good or not.
Yeah, Leslie touched on only looking back 6 months for assets. About 3 months ago, we changed that from a year to 6 months. And really, this is you not telling your referral source or your borrower no. This is just another tool in your tool chest. You know, we have a AE who is out in the Northwest. Her name's Annie. A lot of tech companies out there. So you maybe have someone who cashed out a lot of stock in a tech company, or someone who was just awarded a large settlement but doesn't have a job, or maybe they just had a divorce and they received a lump settlement. So just think outside the box on stuff like that. Don't say no. Say call your account executive from Angel Oak and go through it with them, because you know, just on this call we have, with me included in there, almost 20 years experience just here at Angel Oak. So you know, we have experience of the loans Angel Oak likes to close. So definitely keep us in mind. Don't say no. These loans are going to get done. These borrowers, self-employed borrowers, investors, people who have some credit events in their life, they call us directly. They do not want to be told no. So they're going to get closed. If you choose, 77% of you have not closed a bank statement loan in the last 12 months. 85% of you have not closed a debt service coverage loan in the last 12 months. Those borrowers are going to find a loan officer that is going to do that loan for them. So why lose that potential referral source and that repeat business, because self-employed borrowers hang out with self-employed borrowers. So a lot of questions. We're going to get into, everyone's talked about rate. We're going to talk about, Alina's going to give us a couple scenarios to price out here on our quick quote. Alina and Leslie are available 24/7. This is available 24/7. So Alina, give me a scenario, a couple scenarios to price here.
Sure, John. So let's do a bank statement program and then investor cash. So let's put 5, that's fine. Put 750 loan amount. Put credit score 720. And let's do, I want you guys to see how to kind of give your borrower different options between, let's say, 90 and 85% buckets. So do 90 first. Scroll down. So instead of full doc, we're going to change it to the bank statement program. So you're going to see you requested 90%, max is 90%, par rate is 4.75, and it talks about 6 months reserve. This is how you will also, if you guys look at that blue box called select, this is how you would securely upload your pre-qual documents for your account executive to review. You'll click, you can drag and drop your bank statements, credit report, and 1003. Now, John, when you're talking to the customer, to kind of give them different options. So let's say they're not sure if they want to do 90 or 85. Let's change it to 85. You'll see a drastic decrease in the rate. It goes down to 4.25. Always give that option to them. If you have somebody that's on that cuff of a different bucket for the credit score and there's a possibility to do a rapid rescore for them, let's change it to a 740 bucket. So you can always play around to give them the different options, and you'll see a different rate that's going to be available for them.
Yeah,
So let's price
Alina,
out.
sorry, go ahead. But, you know, just look at this. You're looking at a 399 on an 80%, and this will give you, you requested an 80, but they're eligible for a 90. And again, that 90% rate Alina was showing you, I think it was 4 3/4. That's one loan, no MI. So
Yeah.
just go ahead, Alina, sorry.
So let's price out investor cash flow. Let's keep the same loan amount. Let's do 720 bucket again and 75 LTV. So instead of bank statement, we're going to change it to investor cash flow. You're not going to have pricing because you have it as owner occ, so we need to change it to investment. 4.5% for no income doc, no employment. And if you're comparing it to a hard money lender or anybody else, I mean, that's a phenomenal rate. Phenomenal.
Yeah, so Alina's kind of dipping her toe into how to find these borrowers, but Alina mentioned something here I just want to hit while we're on it. She said a hard money lender. Use this program to get hard money off that hard money's warehouse line. So this is one other way to look at, you know, properties are flying off the market. You know, one of the other things we didn't talk about, delayed finance. And Leslie, I'm going to have you talk about that because properties are, you have to basically close loans. We didn't talk about it. Leslie, while we're talking about rates here, give us what delayed financing is in our world.
Okay, so delayed financing, we actually just expanded it a little bit. Delayed financing is traditionally, you got that borrower who's got a hot deal. He's got the money. I literally just did one 2 months ago. At the end of the year, it was bought it for like 2.4 million. The guy didn't want to wait one more day. He says, I got the money. He literally plunked down 2.4 million. He came back about 3 months, 4 months later, and wanted to go ahead and refinance and recoup some of the money that they had put down. We treat it within the first 6 months just like a purchase. It's not considered cash out. So the guy put 2.4. I think he wanted to finance 80% of it. So we did an 80% loan to value. Basically, it's rate and term, even though we're going to put all that cash that he laid out, a portion of that cash that he laid out, we're going to return that back to him. Okay. It has to be within the first 6 months. We basically just have to source, where that money came from. So prove to us, go back a couple months back or 3 months back, where you bought it. Show us that you did have the cash. It's sitting there, that it was seasoned at the time. And that's fine. We'll go ahead and return that money to him. If they qualify up to 90%, that's fine. 90%, no problem. And it will be the same rate as if it were a purchase. We're not going to tack you for a quarter hit, I think, that we do on cash out.
Right.
So that's a great deal. I know one of the guys in the office here had one teed up. It was literally approved in our system. The guy just couldn't wait. 2 days later, we converted that into a delayed financing deal. So within a couple of days, we started the process to then convert that into a delayed financing deal.
Yeah. So, Leslie, thank you for that. We've seen, with very tight inventory, multiple offers. That's why I'm glad we brought that up. I'm sorry we didn't cover it while we were covering the programs, but I believe it's important enough for you to know that exists here at Angel Oak to help you, whether it's your borrower close a loan, but it's also to help you let your borrower get their finances back that they did, use to purchase that with an all cash deal. We know appraisals are taking longer than usual. So in any of these cases.
Let me have one wrinkle, if you don't mind, on that, because I meant to. So it used to be just cash, right? But now we've added the additional wrinkle. We'll still consider delayed financing if he went hard money. Yep. So again, the guy had to go to the street. He knew he could get the money in 7 days. He couldn't wait. Went to the street, got hard money, and financed that hard money. we will consider taking hard money out also as delayed finance. Again, within the first 6 months.
Yeah, great point, Leslie. It just I've said it along here. Stay connected with your account executive, and we're going to show you another reason why you really need to stay connected with your account executive, because we're going to show you now. I know we're getting close to the top of the hour. I want to show a lot of people have asked, how do we find these borrowers, right? So we gave you an example, hard money. We'll show you how to market there, because I think a couple of you have asked, where do we find these borrowers? So Leslie, let's talk about our marketing portal and what our marketing department has created for you loan officers and originators out there to really not have to do any of the heavy lifting.
Right, so you just logged in, and so you'll toggle to where the marketing portal, what John has toggled, then go back all the way down to the bottom and hit flyers. And there you'll see a whole slew of flyers that we already have made up for you. And when you log in with your own credentials, it will already be custom with your name and all your contact information. You could, if you wish, also add a photo like this gentleman does. And also at the very bottom, you can put in your own disclaimers if you wish to. But it's already basically plug and play. It's already done for you. So you just grab that out of that marketing portal and go to town and market whatever niche you feel that fits best or you want to concentrate on. You just pull it straight off of that marketing portal. Again, there's the asset qualifier, the bank statement. If you want to target CPAs to get some of those self-employed borrowers, again, the non-warranted investments, there's just a whole slew of different messages that we have there that you can go to market with.
And then social media, and again, there's one for every program there. And then, social media is really, a lot of people are using it. So we have posts here they're directed towards realtors or borrowers. And we have one for each program out there. We have multiple ones out there for whether it's Facebook, Instagram, Pinterest. They're all out there. These are all developed for you, either realtor facing or borrower facing. And then we also have, hold on, I think this is the most powerful presentation that we have out there for you. It's a realtor presentation. Just recently, we had one of our Florida account executives do a lunch and learn on behalf of one of his realtors. And this LO had 40 people in the morning and 40 people in the afternoon. And she got 2 loans out of the realtors there. And I promise you, if you do this for your referral source, your realtors, you will get a bank statement or a 1099 or a debt service coverage loan out of that room just with those realtors. So not only are you expanding and solidifying your referral source, you're also going to be getting business from them. I promise you, it works every time. So the way we do this, the Angel Oak account executive will go out on your behalf. So Alina or Leslie or whoever your local account executive is, they will do this. They will deliver this content on your behalf. They'll go through the programs. They don't talk about Angel Oak. They just talk about, hey, go to Joe Smith. He's your loan officer. We're just one of Joe's investors. And that is it. I am promising you, you will get business from this. This is a very, very powerful presentation. I know we're a little bit past the top of the hour. Alina, Leslie, anything to add regarding marketing? Maybe throw out some other ideas on who they should market to. I know, Leslie, you mentioned CPAs. Who are some other people? Hard money you mentioned. Alina, any additional people to market to?
Attorneys, for somebody who had a housing event, definitely for sure. Accountants as well, CPAs.
Yeah.
Also, just in your day-to-day life, when you're dropping someone off as a dry cleaners, you go to your favorite little restaurant. You are interfacing with self-employed borrowers every day. And some of these people you have long-standing relationships with them that you have been patronizing for years. You know, that's a great opportunity to just have a casual, you know, if it comes up in conversation, just people you meet or you interface with on a day-to-day basis who are small business owners. That is our borrower. Okay, that's for the most part, it's that small business owner, and you meet them every day. So
a couple others I'll throw out there. Why not go out to those big banks? You know, the Wells Fargos, the Chases, the B of A's. They're not going to do these. Why not make, you know, acquaintances with the loan officer in that branch and ask them what they're doing with their turndowns? Financial planners and wealth advisors don't want people pulling money out of their investments. We have a 95% full doc or a 90% self-employed borrower. They don't have to put 20% down. You've got, you know, business bankers, lead providers, you know, we've got it all up here. Realtors are your #1 referral source. Educate them and they will expand your circle and you will get more business from them. These loans are going to get done. I know we're a couple minutes past top of the hour. Alina, any final departing words?
Use the marketing portal. There's so many loan officers that complain about their business. They're not where they want to be. And every time I ask them, where are you at? Have you taken advantage of it? The answer, unfortunately, is no. As Leslie mentioned and John mentioned, the work has been created for you. All you have to do is customize. If you can't do that for some reason, you're having a hard time, let me know or let your local account executive know. We can get it done in under 30 seconds and we'll send out the flyers to you. I have one of my national loan officers that refused to do the non-QM products for so long. And recently she lost one of her top referral sources because that realtor went down the street and was able to get non-QM product done. And now they're taking their agency deals there as well. So just be very careful. If you're not doing it, somebody else is definitely going to do it for you.
Thank you, Alina. That's pretty powerful right there. Leslie, any last words?
Well, just dovetailing on what Alina said. You just expand your horizons. Just take the blinders off, look wide. The fact that you're on this call shows that you're looking to go wide. Think of us as consultants. That's what we do. Believe me, I mean, I get calls from first timers or people who just done a couple of times. We will spend all the time you need to educate you, to make you feel comfortable, to hold your hand through the whole process to the day you get paid. And then believe me, the day you get paid, say, oh yeah, this stuff is for real. And then you're gonna keep coming back and back and back. So stick with us, reach out to your account executives. That's what we do. And that's what we love to do, is to help you guys.
Leslie, you said it perfectly. You know, we love doing this and hopefully, you know, their expertise on what they've been doing for the last 3 to 5 years comes through. Your local account executive, if Leslie or Alina are not your accounts, we have experienced AEs that all they want to do is serve you and your customer and your referral source. So, you know, I'm lucky enough, I get to work with Alina and Leslie every day. So thank you guys. It was great seeing you a couple of weeks ago at FAMP. I loved it. Thank you. As Leslie mentioned, you took the time out of your day. This is going to be recorded. We will get this out to you before end of day tomorrow. Thank you for your time. For those of you who have closed loans with us, thank you for your business. And those who will, we look forward to closing your loans for you with the entire Angelo family. Thank you. Have a wonderful afternoon. Thank you for attending.